Right now, while most investors are staring at the same handful of mega cap tech stocks, a much bigger move is happening underneath the surface of the market. Money is not simply leaving stocks. It is rotating quietly, slowly, and strategically into the parts of the market that could benefit from the next major economic shift. Most retail investors will not notice this rotation until it becomes obvious on the charts, in the headlines, and in analyst reports. But by then, the best part of the opportunity may already be gone. The biggest mistake investors make is believing that the S&P 500 is a fully diversified investment. On paper, it represents 500 companies, but in reality, the index has become heavily concentrated in a small group of giant technology names. That means many investors who think they are diversified are actually making a very concentrated bet on the same mega cap companies everyone else is watching. This worked extremely well when interest rates were low, money was cheap, inflation was under control, and the market rewarded future growth. But that old environment is no longer the same. Today, inflation is still sticky, interest rates remain restrictive, governments are spending heavily, geopolitical tension is disrupting supply chains, and artificial intelligence is creating a massive new demand for electricity. This is not a normal market environment. This is a regime shift, and when a regime shift happens, the winners of the last cycle do not always lead the next one. The market does not stop moving. Money does not disappear. It rotates into the sectors that match the new reality. That new reality is becoming very clear. The world needs more energy, more power infrastructure, more natural gas, more LNG capacity, more grid equipment, more uranium, more lithium, more copper, and more critical minerals. Artificial intelligence may look like a software story on the surface, but underneath it is becoming one of the biggest energy stories of the decade. Data centers do not run on hype. They run on electricity. Training AI models requires power. Running AI systems requires power. Cooling data centers requires power. Expanding cloud infrastructure requires even more power. So the AI boom is no longer just about chips and software. It is also about the physical infrastructure needed to support it. This is why energy infrastructure is becoming one of the most important sectors to watch. Many retail investors make the obvious trade when oil prices rise. They look at oil producers, but the deeper opportunity is often in the companies that provide the equipment, services, machinery, and infrastructure that make energy production possible. These are the picks and shovels companies. They benefit from long-term capital spending, infrastructure projects, LNG expansion, and energy security demand. They do not need oil to rise every single day. They need the world to keep building energy capacity, and that is exactly what is happening. One company sitting directly inside this trend is Baker Hughes. It is tied to oil field services, LNG infrastructure, gas technology, industrial energy systems, and energy equipment. When countries need more energy infrastructure, Baker Hughes is one of the companies positioned to benefit. When producers invest in new projects, when LNG terminals expand, when gas infrastructure becomes more important, and when AI creates more pressure on the power system, companies like Baker Hughes become more relevant. But the key is not to blindly chase any stock. The key is to watch whether the story, the earnings, the sector flow, and the technical setup are all moving in the same direction. The second major sector is critical minerals, and this may become one of the most important themes of the next decade. Critical minerals are not as flashy as AI stocks, but without them, the future cannot be built. There is no electric vehicle boom without lithium. There is no grid modernization without copper. There is no nuclear revival without uranium. There are no advanced defense systems without rare earths and specialized materials. There is no energy transition without mining, refining, processing, and secure supply chains. For decades, the world treated mineral supply chains as boring background infrastructure. That has changed. Governments now understand that critical minerals are not just commodities. They are strategic assets. They are tied to national security, energy independence, defense systems, manufacturing, and technology. The United States and its allies do not want to depend on unstable or hostile supply chains for the materials that power their economies. That means domestic production, allied supply chains, government support, and long-term investment are becoming more important. One major name in this space is SQM, one of the world's important lithium producers. Lithium prices have been volatile, and that has scared many investors away. But the long-term electrification story has not disappeared. Batteries, grid storage, electric vehicles, and energy systems still require lithium. SQM's position in Chile gives it major strategic importance, especially as lithium becomes more central to global supply chains. This is not a simple short-term trade. It is a long-term resource and infrastructure story. Another important name is Uranium Energy Corp, ticker UEC. Uranium is becoming more relevant because nuclear power is returning to the center of the energy conversation. AI data centers need reliable electricity 24 hours a day. Wind and solar are useful, but they are not always available. Natural gas helps, but it still depends on fuel prices and supply chains. Nuclear power offers stable baseload electricity, and that is why governments and technology companies are looking at it again. If nuclear demand rises, uranium becomes strategically important. UEC is positioned as a domestic uranium company at a time when the United States wants more control over its own energy materials. But this is where discipline becomes very important. A powerful theme does not mean every stock is a buy at any price. Energy stocks can be volatile. Lithium stocks can fall sharply. Uranium stocks can move violently. Even when the long-term thesis is correct, the short-term price action can punish investors who enter carelessly or size too aggressively. That is why serious investors do not just buy a good story. They wait for confirmation. Retail investors often try to buy at the bottom because they want the perfect price. Institutions usually wait for evidence that buyers are taking control. They look for consolidation, breakouts, stronger volume, higher lows, improving earnings, and sector strength. A stock breaking above resistance with strong volume can signal that institutional money is entering. That does not guarantee success, but it gives more evidence than simply guessing. The correct framework is simple. First, study the macro environment. Second, identify the sectors that benefit from that environment. Third, find the companies with real exposure to those sectors. Fourth, wait for the right entry and manage risk. Most retail investors do the opposite. They hear a ticker, fall in love with the story, and then search for reasons to justify buying it. That is dangerous because once you become emotionally attached to a stock, you stop seeing the risk clearly. The biggest risk in this market is not only choosing the wrong stock, it is choosing the right theme but entering with the wrong position size. Many investors correctly identify a major trend, but they put too much money into it. Then, when the stock drops 20%, 30%, or even more, they panic and sell at the worst possible moment. Long-term structural trends do not move in straight lines. They shake people out. They test conviction. They create fear before they reward patience. That is why position sizing matters more than excitement. You should never hold more of any single stock than you can emotionally and financially handle. If a position is so large that normal volatility forces you to panic, the position is too large. The goal is not to predict every move perfectly. The goal is to survive the volatility long enough to benefit if the long-term thesis plays out. The bigger picture is this: the old market was built on cheap money, global supply chains, low inflation, and passive flows into mega-cap technology. The new market may be built on energy security, critical minerals, nuclear power, grid expansion, defense supply chains, and physical infrastructure. Technology will still matter. AI will still matter, but the winners may expand beyond the obvious names. The money may start moving into the companies that make the AI world physically possible. That is the rotation most people are missing. They are watching the same 10 stocks while institutions are looking at power grids, LNG terminals, uranium production, lithium supply, copper demand, and energy infrastructure. They are looking at where governments are spending. They are looking at where supply is tight. They are looking at where demand is structural, not temporary. And when private demand, government policy, and institutional capital all point in the same direction, serious investors pay attention. So the real question is not whether the S&P 500 goes up or down next week. The real question is whether you are only positioned in the winners of the last cycle or whether you are studying the sectors that could lead the next one. Because by the time everyone agrees that energy infrastructure, uranium, lithium, and critical minerals are major market themes, the early opportunity may already be gone. This does not mean you should blindly buy Baker Hughes, SQM, UEC, or any other stock. These companies should be studied as examples of a much bigger shift. The real lesson is the framework. Follow the macro, find the sector, study the company, wait for confirmation, manage your risk, and never confuse a powerful story with a guaranteed investment. The quiet money rotation is already beginning beneath the surface. So score and dap de waste tide of waste. The market may look calm from the outside, but underneath, capital is moving toward the sectors that solve the next decade's biggest problems: energy, power, minerals, security, and infrastructure. Most people will only recognize this after the headlines arrive, but the best investors pay attention before the crowd understands what is happening. If this video gave you value, like the video, share it with someone who needs to understand what is really happening under the surface of the market, and subscribe to the channel for more deep market breakdowns. And make sure you watch the next video, because in that one, we will go deeper into the signals that show when institutional money is entering a stock before the public crowd arrives.